Hello folks, this is Tony Drake from Drake & Associates with an educational economic update for December 2018. In this month's video, I'll discuss some of the market headlines that influenced markets in November. I'll also provide some insight into what these developments could mean for you as an investor. As always, please stay tuned at the end of this video for a required disclosure statement. November closed on a strong note despite a month of volatility. Details like trade disputes, oil supply, and dropping prices caused markets to fluctuate throughout the month. But by month's end, investors showed optimism as the market rebounded. For the month of November, the S&P 500 rose 1.8%, the Dow was up 1.7%, and the Nasdaq experienced a slight 1/3% bump. One reason for November's upturn was the annual G20 summit in Buenos Aires. At the anticipated meeting between President Trump and China's President Xi. Ahead of their session, the Dow rallied nearly 200 points. The leaders plan to meet to discuss cooling down the tense trade environment in hopes of finding a consensus between the two countries. In addition, President Trump, the Mexican president, and the Canadian Prime Minister signed a U.S.-Mexico-Canada agreement, which still must pass Congress. While some are hopeful that the North American Free Trade Agreement replacement will resolve trade disputes, others still remain skeptical. G20 news also impacted oil, which had its largest monthly decline in 10 years. Continuing from October, oil prices fell 22% through the month on fears of an international surplus. Leaders from Saudi Arabia and Russia met at the summit to discuss solutions before OPEC's December meeting. These developments boosted investors' confidence. Updates on interest rate hikes also helped November finish on an upswing. On Wednesday, November 28th, Federal Reserve Chairman Jerome Powell remarked that interest rates are close to the current neutral range of 2.5% to 3.5%. His comments seem to suggest that the Fed may throttle back interest rate hikes, which cause stocks to rise. Still, economists expect interest rates to increase in December and in 2019. Additionally, we saw a variety of key data that was released last month that suggested the U.S. economy is still on track for growth. U.S. factory production climbed higher than expected, with the ISM Manufacturing Index beating expectations at 59.3. Any number above 50 shows growth in the industry. Still, construction spending dipped for the third month in a row, falling 0.1%. Consumer confidence remains high, although it slipped a little bit in November after an 18-year peak. This index suggests that some Americans are worried about their income and the state of business in the U.S. However, tax cuts and a solid labor market have helped boost consumer sentiment. Further, we learned that economists predicted more than 200,000 jobs were added in November. This development keeps unemployment hovering near 3.7%, the lowest in 48 years. Also, revised third quarter GDP numbers showed 3.5% increase, with corporate profits reaching a 6-year high. Together, these indicators are healthy and suggest the economy is on the right track as we close out the year. As additional information from November becomes available, we'll have a clearer understanding of the month's performance. But with trade and oil conflicts and talks at the G20 summit, investors can now turn to December and the new year. As always, we encourage you to continue to focus on the fundamentals. That's it for this month's Educational Economic Update. Once again, this is Tony Drake from Drake & Associates, signing off for the month of December 2018. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, as always, give us a call. We'd be happy to talk to you. Thanks.